forecasters generally were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, you know, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. It didn't really happen. We're still at 3.7%. So we've seen you know, strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's you know, that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year. Whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, you know, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, you know, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, you know, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, you know, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, you know, 60, 90 days ago. So that's how that's how we're approaching things. And you know, as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to you know, to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully, so as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy.
Yeah, I think it's a short squeeze.
And those are going to show up in market conditions, or they won't, you know. But in any case, we have to do what we think is right. And, you know, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and you know, I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not, you know, calling into question the progress. It's great. We just need to see more. We need to see, you know, continued further progress toward getting back to 2%. That's what we need to see. So, you know, it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on you know, doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, as we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, you know, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%, but you know, if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably we'll keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean, ultimately, that we would need to hike again. It just is, it's the way our policy works.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire.
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if
Live now.
the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And, if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict.
Yeah, but if they overdo it, though,
progress on
potentially
inflation,
businesses
and
would
the
go out of
labor market
business
remaining
and
strong,
people
ideally
lose their jobs,
without seeing
and
the kind of large increase
if
in
bigger
unemployment
corporations
sometimes.
would collapse, that would
When
prolong the
you
pain.
begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox
That's
Business.
correct.
So, if the Fed cuts rates as the dot plot
Realistically,
is
the only
showing
way to
about
lower
75 basis
rates
points,
without
does that
government
signal
intervention,
or
which
that there's a
the
belief
Federal
of
Reserve is not the
weakness
government, is
next
by
year
raising
in the
unemployment.
economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something,
This is
this,
why
but allow me
crypto
to
in
say
the
it
whole
again.
first place.
We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate.
Right.
them.
It is.
So,
It seems
it's
ass
important
backwards
for
because it
people to
is
know that.
ass backwards because
Um,
this is why
But
we
it wouldn't
crypto
need
in
to
the
be
whole
a
first
sign of-
place.
It could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've
Yeah,
heard from
that's
in other
right.
meetings. How
2029,
sticky is core
the big
inflation right
one.
now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing in at different levels,
Mr. Rogers
meeting
movie.
by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
There were no surprises. That's right, because the market is forward-looking.
Our questions. I just wanted to ask a little bit about, we had some pretty
Many of
positive
states
data
oppose
this,
yeah,
this
CBDCs
morning
are
and
not
yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the, you know, the translation into PCE. So it's very, very late in the game, you know, but
They're
nonetheless,
prolonging the inevitable. That's right.
participants are
Not only are they
allowed
prolonging
to
the
encouraged
inevitable,
to
they're
update
measuring it in the
their
most favorable
SEP
way
forecasts
humanly possible.
until
That's not
probably
real.
mid-morning today.
Last
After
year
that,
when
so
inflation
staff
was
has to
8%,
accumulate all of
but
that
your
and
food
create
bill
the
doubled,
documents that you see.
that's
So
coin clipping, and
until
that's
about
not real.
mid-morning, a little, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Do you see, I mean, how are you, when you
That's
think
the same
about,
thing that the
you know,
Roman Empire
starting to
did
think about the rate cuts
when they
next
took
year
the
or
8-gram
whenever they
gold
come,
coins, clipped the
how do
edges,
you-
and gave it
you
back
know,
to
How do
them
you think about
at
the
6 grams
economy
and
where we're
5
now kind of
grams
post-pandemic?
and
Do you
4 and a
think that there's
half. They
been
presented it
significant
as though it
structural
were
shifts, and is
8
that gonna
grams of
change
gold,
how
even
you
though it was
look
only
at
4.5
the rate
grams.
cut path?
This is modern day Roman Empire activities right
The
here.
question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have
That's
risen,
why they put rigid
that
on the
would
coins.
mean
That's
that-
right.
That interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. You know, people will be writing papers about that 10 years from now and still fighting about it.
That's right.
So
Diluted
it's
gold
just
with
that it's
yep,
going to be
that's-
uncertain.
it's all the same
So
thing.
We're going to
And
be
right
making
now,
policy in
it's
this,
the same
you know,
thing. It's
difficult,
just modern
uncertain, really
day.
unprecedented
When they
environment.
tell you inflation is
Someone once said that
3.2%,
you know
but your
the-
food
you
bill
know
has
the natural
doubled.
rate of interest by
That's
its
not
works.
3.2%,
And
because the way
that's
that they
really
measure
right, but
inflation
that's
is
very
not real.
difficult because policy
It's coin clipping.
operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year.
This is why we
reducing
crypto in the
pace at
first
which we were
place.
adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work.
They don't use the same items
In
every
terms of
time either. That's
demand,
that's
has
right,
demand
by
shifted
design,
more
because
away from
they present
services
it in
into
the
goods?
most
You
favorable
can make
way
a case for
humanly
that,
possible.
The shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
This is why Bitcoin.
You said back in July that you needed to start cutting rates before getting to 2% inflation. As you
Bitcoin's
mentioned,
running right now,
PCE
too.
inflation is now running at 3.5 on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at
PBR held
Supercore and
value pretty
Shelter,
well.
they are of course stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2%
that's-
to
that's
cut
right.
rates is
No,
that
you got it.
policy would be,
Hit the cow.
it would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity,
Like when they cut rates,
you know,
it causes a recession
it takes
every
a
single
while
time.
for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP,
Yes, like
and,
literally they
you
are
know, I think you'll
manipulating the
see a
markets.
reasonable estimate of the time lags and things like that it would take.
3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
If I say a number, it's going to be wrong because I can never be right.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation.
Will we see
question.
2%?
Over the
On
past
paper, we
couple
will,
of years,
not
a
in
lot of
reality.
central bankers have talked about
Gold
the
is
more difficult
2%.
last mile of
If
getting
you want like
inflation back down
actual
to
2% inflation,
Yet
just
it's also been
hold gold.
surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think I think this, you know, we felt since the beginning that it would
Jack,
be a combination
777,
of two
all of it.
factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two
Right,
things
'cause we haven't
were gonna
even
be
paid that
necessary.
bill
Sorry,
yet.
say the last part of your question again.
The U.S. dollar is down 57%
Like
of
there's something
purchasing
different
power
about the
since
US
9/11
economy.
happened.
Yeah, so it's not that, it may or may not be about the U.S. economy being different. I think that this inflation was not the classic
See how much she wants
demand
for it. Yeah,
overload.
actual gold is like literally
pot boiling
1.8%
over
inflation.
kind of
We
inflation
find
that we think
roughly
about. It was a
1.8%
combination
every year
of
with technology.
very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a
Which is
we
why
had a
that's their
participation
target
shock.
rate is 2%.
So this is just
'cause
very
of the gold
unusual.
standard.
And, we had the view, my colleagues and I broadly had the view that
And
we
they
could
want
get
to
a
present it
lot
as though we're
of,
still on the
you
gold
had
standard,
essentially a
even though
vertical
we're
supply
not
curve,
anywhere near that.
because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced, and something like that has happened. It happened so far. The question is,
Yes,
once
silver is
that
one of the most
part of it
manipulated
runs out, and we
markets
think it has a
of all
ways to
time.
run. We definitely think that the
Not since
the
1971.
sort of
that's
supply
right.
chain and shortages side has some ways to run. Does labor
So
force
time to buy a
participation
house?
have
It's
much
always
more to
time
run?
to
It
buy a
might.
house, in my
Immigration
opinion.
could help, but
It's always
it may be
time
that
to
at some
take
point
your
at
fake
some point you will run out of
Fugazi
supply side
money,
help, and then
aka
it goes
U.S.
down to
dollars,
demand, and it
and
gets
buy
harder.
real stuff.
That's very possible.
Such as silver,
But
gold,
to say with
land,
certainty that the
Bitcoin,
last mile
it's
is gonna
always
be
time to do that.
different, I'd be reluctant to.
Because at the end of the day, I can
to-
assure you that
to
that thing is
suggest that
going
we
to
have any
zero. It
certainty
basically
around
already
that. We just
has.
don't know. I mean,
98% of the
inflation
value
keeps
is
coming
lost since
down.
1971.
The labor market keeps getting back into balance, and it's so far so good. Although
Right, because when
kind of
the
assumed
rates
that it
listen,
will
I'm
get
not a
harder from
financial
here,
advisor,
so
but when
far
the
it
rates
hasn't.
drop, it's going to be a bidding war like crazy. And if you can afford to get it, you can always refinance later.
Megan Casella with Barron's.
But
I want
if
to
you
ask
think
about the
that
balance
people,
sheet, given the
everyone
Fed's
else
focus
isn't
now
waiting
on
for
proceeding
rate drops,
carefully
you're
and
crazy.
considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
I can assure you that it'll be bidding wars just like it was in
We're not
2020,
talking about
2021.
altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much
Yeah,
as
nickel,
expected. What we've been
one
seeing
nickel like that
is,
you have, like
that we're
5
allowing
cents, it costs
runoff
8 cents
each
to
month.
make
That's
a nickel.
adding up. I think we're
Or
close to
metal
1.2
value.
trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At
Dollar
a certain
cost
point,
average, nada.
Buy
Buy a little bit each and every week.
to come out of, or there'll be a level where the reverse repo facility levels out, and at that point reserves will start to come down. We still have that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat
Gold,
above
actually, if you buy
that consistent
1
with
ounce
ample
or more,
reserves.
there's no taxes because it's just a
And
currency
we also intend
transfer.
to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts?
How come crypto is heading up?
Rethink, or are you still going to follow?
Because it's
that
micro Wyckoff
thinking?
accumulation short squeeze. The bears were beating their chest after a little 7%, and they're
So-
wrecked right now.
I think they're on independent tracks. So you're asking though the question. I guess you're implying the question of can you
Is the real reason the actual
continue
like
with QT?
The reason is because no rate hikes.
At such time,
But that's the
QT,
real
which is a
reason.
tightening action, at such time as policy is still tight. And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
All right, guys. That is gonna be it for this time. I will probably live stream this evening, and we'll do some like charts and TA and all that. Make sure you guys like, subscribe, follow me on TikTok, YouTube, Twitter, Instagram. You can join the Patreon for $10, and I can teach you everything that I know. If you want a portfolio review, that is on my Patreon as well. That is $53. I appreciate every single one of you guys. Peace, love, prosperity. God first. God bless. I'm out.
Damn hustling, 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 hustling,
Hit ya,
hustling,
boy.
hustling,
Ski.
hustling, hustling.